In crypto, you're always told to watch out for scams. Rug pulls, Ponzi schemes, they're the usual suspects. But what if the biggest threat wasn't some anonymous developer, but the very exchange you were told to trust? What if one of the most powerful players in the game was allegedly creating money out of thin air? This is the alleged story of FTX's phantom tokens, synthetic digital assets supposedly created from nothing. It's a financial conspiracy theory backed by compelling circumstantial evidence that points to a massive fraudulent plot. Some believe it was designed to destroy one of crypto's most ambitious projects for the benefit of another. We're about to break down how they allegedly did it, why the motive might have been to eliminate a powerful competitor, and how, according to some accounts, the blockchain itself ultimately rejected their fake tokens. To get the scale of this, let's rewind to May 10th, 2021. This was Genesis, the launch of the Internet Computer, or ICP. After more than 5 years of intense R&D from the Dfinity Foundation, the project was finally live. The vision was huge, a world computer blockchain that could host entire applications on-chain, breaking the internet free from the grip of big tech cloud services. The hype was off the charts. On day one, ICP listed on every major exchange, Coinbase, Binance, and of course FTX. Its fully diluted market cap briefly shot past an incredible $230 billion, putting it in the same league as Bitcoin and Ethereum. And then the floor fell out. The price didn't just dip, it nosedived week after week. It plummeted, wiping out billions. Almost immediately, crypto Twitter and YouTube had a verdict. ICP was a scam, a pump and dump by its own insiders. The reputation of a project 5 years in the making was torched in weeks. But was that the real story? That simple narrative that ICP was just another failed project started to fray as crypto sleuths began digging. They asked a basic question: how could a project with so much legitimate tech behind it collapse so perfectly? The answer, many now believe, lies with FTX and something called a perpetual futures contract. Here's where the plot thickens. 4 days before the Internet Computer blockchain even went live, before a single real ICP token could be sent or received, FTX launched a market for ICPPERP. So, what's a perpetual future? Simply put, it's a way to bet on an asset's future price without ever actually owning it. If you think the price will go up, you go long. If you think it'll go down, you go short. These markets are highly leveraged and incredibly influential. In traditional finance, they're heavily regulated. In the Wild West of crypto circa 2021, they were weapons. The fact that FTX listed a futures market for a token that didn't technically exist yet wasn't just weird. According to investigators, it was the key that unlocked the entire scheme. It allowed a paper price for ICP to be set before the real market could find a price on its own. It created a shadow market where powerful players could place their bets. For days, the price on this pre-launch futures market grew slowly, but in the 7 hours just before Genesis, something snapped. Trading volume on ICP Perp suddenly exploded, surging by 30 to 40 times. In just those few hours, over $241 million worth of these synthetic ICP contracts were traded on FTX. This frenzy drove the paper price of ICP into the stratosphere. The theory, which is supported by market data analysis, is that this was a deliberate pump. By artificially inflating the futures price, manipulators could ensure that when the real ICP token launched on exchanges like Coinbase, it would open at a crazy high price. Arbitrage bots would see the price gap and instantly buy up the real tokens, forcing the spot price to match the inflated futures price. The market was effectively tricked into accepting a fake price as real. But according to this theory, the goal wasn't to keep the price high. It was to make the crash as brutal as possible. While the price was being pumped, Sam Bankman-Fried's trading firm, Alameda Research, was allegedly building massive short positions, betting big that the price would collapse. At the same time, an even more serious allegation emerged that FTX was selling phantom ICP tokens. The theory goes that when a user bought ICP on FTX, they weren't getting a real on-chain token. They were getting an IOU, just a number in FTX's internal database. This would have allowed FTX to create a limitless supply of paper ICP to sell to the public, creating artificial selling pressure that the real asset could never hope to survive. When the actual ICP token went live, it was born into a perfect storm, a massively inflated price it couldn't sustain, huge leveraged short positions pushing it down, and a market allegedly flooded with phantom sell orders. The crash wasn't an accident, it was engineered. This is a complex web of alleged manipulation, and it's just one piece of the puzzle. If you want to support deep dive investigations that uncover the hidden forces shaping crypto, take a second to hit that like button and subscribe. It tells the algorithm these stories matter. If this devastating scheme really happened, The big question is why? What was the motive? Many analysts who've dug into this point to one powerful theory, eliminating a rival. At the time, FTX and Sam Bankman-Fried weren't just running an exchange, they were kingmakers. Through Alameda Research, they had poured billions into their own ecosystem of blockchain projects. The crown jewel of this empire was Solana. They had every reason to want Solana to win the layer 1 race. An internet computer, with its world computer ambition, was arguably the biggest technological threat to that dominance. This setup, where the exchange, FTX, the high stakes gambler, Alameda, and the horse in the race, Solana, are all connected, created a massive conflict of interest that would be illegal in traditional finance. From this viewpoint, the alleged attack on ICP wasn't just about making money on a short trade, it was a strategic hit to neutralize a competitor and protect their multi-billion-dollar investment in Solana. By wrecking ICP's reputation from day one, they could help ensure developers and capital would flow to their ecosystem instead. While not proven in court, the circumstantial evidence is potent. They had the means, motive, and opportunity. This is where the story takes a fascinating turn. One that shows the raw power of a blockchain versus the paper promises of a crooked exchange. This part of the narrative is based on anecdotal accounts from those close to the events, but it fits perfectly with the widespread fraud later proven in FTX's collapse. The story goes that at one point, a project that had partnered with FTX tried to withdraw the ICP tokens they were owed. But when FTX tried to process the withdrawal, the transaction allegedly failed. The internet computer blockchain simply wouldn't accept the tokens. Why? Because, according to these accounts, the tokens FTX was trying to send weren't real. They were fakes minted inside FTX's private ledger. A blockchain doesn't care about your brand or your reputation. It only cares about cryptographic proof. These phantom tokens didn't have the right digital signature. The blockchain, doing exactly what it was designed to do, rejected them. This single alleged event is a perfect microcosm of the entire FTX fraud. The SEC later charged Sam Bankman-Fried with orchestrating a years-long scheme to defraud investors, secretly diverting their funds to fuel risky bets and political donations. The phantom tokens allegedly used against ICP weren't a one-off. They were seemingly standard operating procedure for an empire built on lies.